The OMAH ETF, named after the Oracle of Omaha, gives investors access to Warren Buffett's wisdom with a 15% dividend, right? Sort of. Berkshire Hathaway has produced incredible returns for decades, but he's been adamant about never paying a dividend. So, is Omaha the solution to give you both? In today's video, I'm going to show you how to evaluate Omaha like a professional because, well, I do that for a living. Well, we'll start with an overview of the key underlying holding, Berkshire Hathaway, and then dive into the specifics of the OMAH ETF to show you how it works and how I'd expect it to perform in terms of income, total return, and taxes going forward. Let's dive in. So, what is Berkshire Hathaway anyway? I think few people actually know. It's a company, or is it like a mutual fund, or is it private equity, or is it just Warren Buffett's investment portfolio? Here are the basics. In the 1960s, Warren Buffett bought Berkshire Hathaway, which at the time was a boring textile company. He used the cash it generated to buy other companies. Now, Berkshire owns or controls 189 businesses. These non-quoted, meaning not publicly traded, controlled equities are worth far more than the smaller stakes Berkshire Hathaway has in publicly traded, aka marketable securities. But that is what most investors tend to focus on. So, what are you really buying when you buy Berkshire Hathaway? Well, for some rough, simple math, the company is worth about $1 trillion. About half of that value comes from the fully or mostly owned businesses, which are generally in boring, stable industries like insurance with its biggest company, Geico, and then other things like railroads, utilities, energy, etc. So half of Berkshire Hathaway is that. Then there's about a third of its value basically in just cash and treasury bonds. And the remainder, roughly a quarter of the value of Berkshire Hathaway or a little more, is in stakes of publicly traded companies that most investors focus on. That will be important to remember as we continue to get deeper into the specifics of the OMAH ETF. The OMAH ETF basically has two components: core equity exposure and high monthly income generation from writing covered calls, which it does actively with a target income of 15% per year paid out monthly, so about 1.25% per month. Let's break down each component in a little more detail, starting with the core equity exposure. I would probably call it more like value equity exposure if you ask me, since most of Berkshire is invested in value-oriented companies, but that's probably not the most important thing to focus on. Remember how I said the public equity portfolio was only about a quarter of the value of Berkshire? Well, it's much more than that in Omaha. More than 90%, actually. What they do is buy Berkshire Hathaway and the 20 largest public equity holdings in Berkshire's portfolio in the proportion that Berkshire holds them in, according to the Vista Shares CEO. So if we look at the top 10 holdings as of May 27, 2025, we can see that Berkshire's stock is only about a 10% position. And of course, of that 10%, about 2.5% is invested in the public equity portfolio. So really, over 90% of Omaha's exposure is to Berkshire's public equity portfolio, whereas only about a quarter of Berkshire Hathaway's current value is in that portfolio. So you're not really getting Berkshire Hathaway exposure here. Kind of, but not the direct investment in the company you probably thought you were getting. Now let's take a deeper dive into the income portion. The first thing you should notice is that income is the primary objective, and capital appreciation is second, meaning less important. And actually, I'm skeptical that this will offer any capital appreciation. More likely the opposite, for investors who are taking out the income anyway, but we'll get to that in a moment. One good thing about the way they actively manage the options portfolio is that they're willing to use call spreads when the time calls for it. Put simply, selling covered calls caps your upside potential because in exchange for the income, whoever bought that call option from you is entitled to all of the stock's return over and above the strike price. If the stock goes up, they benefit, not you. A call spread sells a covered call, but then buys a cheaper call option further out of the money. So if there's lots of upside, the ETF can participate again. Imagine a stock is at $10 a share. They sell a call option for $1 with a strike price at $12. So they collect $1 of income, but if the stock's price goes over $12, they don't participate in that. A covered call spread would be like also buying a call option for 25 cents with a strike price at, say, 15. So your income goes down from $1 to only 75 cents because you sold an option for $1 and you bought one for 25 cents. But instead of giving up all the upside if the stock goes up beyond $12, now you only give up the upside between $12 and $15. Remember, in our simple example, the stock was at $10. So if it went up to $12, you'd capture those gains. Then if it went up to $15, you'd miss out on those next $3 of gains. But if it went up to $20 or anywhere beyond 15, then you capture the gains over and above 15. Another important nuance about how they manage the income is that it's active, and they only target 15% income or 1.25% per month. I like that a lot. The caveat is that it requires them to make the right decision, but if they do what they say, they can help mitigate one of the biggest downsides, actually maybe the biggest downside of covered call ETFs, which is that they cap the upside. Of course, this approach will also cap the upside. There's no getting around that. But since a lot of the stock market upside comes in short periods of time, and the premiums, aka the income from call options, gets higher when there's a lot of volatility, in volatile times, this fund can generate its 1.25% monthly yield faster than normal, and then reposition the portfolio to capture more of the upside from there if the market recovers. That's actually what happened in April. I saw an interview with the CEO of Vista Shares, which is the company that launched this ETF, and he said that in April 2025, when the market was super volatile, they generated their monthly income target in just the first week, and then they were able to focus more on capturing the upside potential after that. So I do think their approach to income generation is better than most other covered call ETFs I see out there. The active management will cost you 95 basis points per year or 0.95%, but it could end up being worth it if they're able to navigate those environments successfully. So where does that leave us? Well, it does have some redeeming qualities like a potentially better approach to covered call writing than most other covered call ETFs, and a lower volatility underlying portfolio than a lot of them. I would think twice about investing in Omaha for 5 reasons. 1, Berkshire Hathaway may not generate the same returns it once did. Warren Buffett just retired and handed over the reins to Greg Abel. Supposedly, he'll keep the same process, and he's been involved for a while, but Warren Buffett was not only managing the company, he was also managing about 90% of the public equity portfolio. It's hard to say whether Greg and the other portfolio managers can live up to the standard of replacing one of the greatest investors of all time. Those are honestly just some pretty big shoes to fill, and in the mutual fund space, when a great active manager retires, the successor rarely ever is able to repeat their success. That would make me want to temper my expectations for Berkshire in general. Number 2, you're not really getting Berkshire Hathaway exposure here. I mean, a little, kind of, but remember that over 90% of the stock exposure in Omaha is to the top holdings of Berkshire's investment portfolio, and those only make up around a quarter of Berkshire Hathaway's current value. Number 3, even if Berkshire Hathaway does generate strong investment returns, investing in a portfolio of its top companies might not capture those returns properly. Why? Because we don't know what Berkshire Hathaway buys until they file their quarterly report more than a month after the end of the quarter. So they might have bought a stock when it was cheap in a downturn 3 or 4 months before this ETF will buy it. If you just buy Berkshire stock directly, you'll get exposure to their decisions in real time. And of course, all of Berkshire Hathaway's other businesses. That's just really not what you're getting in this ETF. Number 4, its short-term covered calls on individual companies are highly tax inefficient. And that means that the income will likely mostly be taxed at your ordinary income tax rate. And number 5, last but not least, the math just doesn't really work. Put simply, you can't take out a 15% income stream from an investment that only earns 10% per year. If you do, a lot of what they call, quote, income will ultimately just be return of capital, meaning they're giving you your money back. And if you withdraw your money out of your account every month, what will happen to the value of your account? It will go down, right? That is what is very likely to happen to the NAV of this ETF over time. Looking at Berkshire Hathaway, a portfolio of 1/3 cash and 2/3 boring low-return businesses, I just don't see how it's likely to generate 15+% annual returns over the next few decades. And if you say it's because Warren Buffett is amazing, well, Warren Buffett is retired. So the income percentage may stay stable over time at around 15% per year. But that means 15% of the NAV. If the ETF's underlying holdings don't earn high enough returns to cover the income it's paying out, the NAV will decline. And if the NAV declines, that means the income will decline. Right now, the price of the ETF is about $19 a share, so it'll start out at 15% of $19. But then over time, it will be more like 15% of $17, and then 15% of $15, then 15% of $10, and so forth and so on. Due to the call spreads and lower volatility underlying holdings, I don't think this will have the same level of NAV erosion as some of the more high-octane covered call ETFs out there, but I think over 10 years, it is likely to be pretty significant. And in my opinion, a falling income stream and falling NAV just aren't a very good recipe for a long-term retirement plan. If you found this video helpful, hit the like button, hit the subscribe button, and leave us a comment to let us know what you want us to cover next. By the way, if you want to get access to my partner Kyle and I directly, there are two ways you can do that. First, you can join our free Discord. And second, if you really want to take learning how to invest like professionals seriously, you can join our academy. Both the links are in the description. Thank you for watching, and we'll see you in the next one.